Welcome back. I'm Rich Krafcik with Cobblestone Asset Management, and today I want to talk about the Fed taper. We're starting to see more chatter about this. We believe it's going to be something important to keep our eyes on in the months ahead. So we're going to talk about what it is, why it's needed, and what the impact is. Let's start by taking a look at the Federal Reserve's balance sheet. So as you look at this balance sheet, you can see several different waves that brought the asset total higher. Those are our quantitative easing periods. The Fed is buying assets to support the economy for a variety of reasons, and it's building up the value on the balance sheet. If you notice the different time periods, such as 2018, when this total actually starts to slope downward, that is the taper. The Fed is discontinuing the purchase of bonds and other assets, and they're letting what they already have on their balance sheet start to mature and roll off. It's a healthy thing. It helps to reduce the overall balance sheet of the Fed, and it gives them some ammunition so that in the future, if they need to then buy more, they're starting from a lower total point. So why would the Fed taper, and why now? Well, first of all, the Fed is watching the value of the US dollar closely, and we're starting to see inflationary data. Now, if you're watching this and you're thinking you're starting to see it, I completely understand. If you've looked at buying construction materials, lumber, groceries, or have filled up your gas tank in the last year, then you've probably already realized prices have been on the increase. But for the data that the Fed watches, they're now seeing some concerns there. So they feel like they need to taper to help pump the brakes on the increase in prices that we're seeing across the economy. What I'd like to show you next is the yield curve. And I'd like to explain a bit of how the Fed uses their tools to shape this curve in different ways. If you notice, it has an upward slope. The longer you borrow, the higher the interest rate, and vice versa. If you were to lend over a longer period, it'd be reasonable to expect a higher rate of return on that money that you've lent out. So that's the general premise that's leading to an upward slope. And an upward slope typically indicates we're in healthy economic times. Now, the Fed is able to control the overnight lending rate. And that's worth a second here, because when you hear the Fed is raising rates or cutting rates, that's referring to the overnight lending rate. That's the only rate that they directly set through their policy. The rest of this curve is moved by market forces. So when the Fed buys assets, if we could look at that purchase in isolation, it would have the impact of putting downward pressure on the rest of that yield curve. So when the Fed begins to taper, it's going to have the opposite effect. It's going to put upward pressure on this yield curve. Now think about why that happens. The Fed is a large market participant. It typically telegraphs its moves. If you know you have a buyer in the marketplace of a certain asset, it's going to drive the price of that asset higher. And if we're talking about bonds that pay interest, more expensive bond is going to give you a lower interest payment as a result. All right, now the opposite is true. If the Fed is going to be a net seller, the price can move lower in that asset class, and if that asset class is bonds, like it is in this case, then the interest rate on those bonds will go up. Let's now talk about how a change in interest rates could impact stock valuation as well. Current level on the S&P 500 is just over 4,700, 4,701. The one-year forward earnings expectations are 218 points. If we take the price divided by earnings, we get a PE of 21.6. If you flip that upside down, you now have earnings divided by price. And this would be 4.6%. That's the earnings yield on the S&P 500 using the one-year forward PE ratio. Let's compare that versus the 10-year Treasury, which as of right now is 1.51%. Investors today can invest in stocks, taking the risk associated with a stock-based investment, and in return, they have an earnings yield of 4.6%. Or they can take the 10-year, which in finance classrooms around the world is considered the risk-free rate, and that is a 1.51%. So the spread between 4.6 and 1.51 is our risk premium to invest in equities. If that 10-year Treasury bond starts to go higher, and instead of paying 1.5, it's now paying 2.5 or 3.5, some percentage of the market that says, oh, I'll take the risk premium on the equity side, starts to move and say, well, give me some of that bond rate of return. We didn't want it at 1.5, we'll take it at 2 or 3 or 4. and so forth. So what we're watching closely is as 10-year Treasury yields move, particularly if they rise, we want to watch how equity valuation adjusts as investors face that decision of stocks versus bonds on a daily basis. All right, so we hope that this short video helps you understand what the Fed taper is, why they're doing it, why it matters, and not just to bond investors, why it matters to stock investors as well. We think it's going to be something talked more about in the coming months, and we wanted you to go into those conversations more knowledgeable and ready to understand what's being discussed.